From dreams to debt, how rising interest rates affect you, me, and the economy. Hello everyone, I am Suraj Deo and welcome back to Deo Talks, your very own community for all things health and finance. Alright, today let's talk about how rising interest rates affect you, me, and the economy. Let's start with the basics. So what exactly are interest rates? Well, think of them as the cost of renting money from a bank or lender. When you borrow money for buying a house or a car or for higher education or for starting a business, you have to pay back more than what you borrowed, and that extra amount is the interest. When interest rate goes up, you will have to pay a higher rent for the money you need. So let's dive in and see how these rates can impact your everyday life. But before we get into that, let's understand the role of central banks like the Reserve Bank of India, the Federal Reserve in the United States, and the Bank of England in the UK. These financial powerhouses play a crucial role in managing the economy and controlling inflation. A central bank acts as a bank for commercial banks like the SBI, SDFC, and ICICI Bank in India. Similar to how you earn interest on your savings account, commercial banks earn interest when they keep money with the central bank. They also lend money to each other and earn interest on those loans. When interest rate goes up, commercial banks earn more on their reserves and might choose to keep their money with the central bank rather than lending it out to somebody. If they do choose to lend it out, they will raise their interest rates to make it more profitable. And you might know that these central banks have the power to increase interest rates. But why would they do that? Well, it's all about finding the right balance between thriving economy and controlling prices. Let's see how it all fits together. When inflation occurs, the purchasing power of money decreases, which means you can buy fewer things with the same amount of money. However, when things get too expensive, it can hurt the economy and make life harder for all of us. That's when the central banks step in and raise interest rates. Take the Federal Reserve in the US as an example. They have increased their key interest rate 10 times since the start of the year 2022. As a result, the benchmark rate has increased from 0.25% to almost 5.25% today. Similarly, the Bank of England has also raised interest rates for a 13th consecutive time to an almost 5% now in July 2023 from a low of just 0.1% in late 2021. These are significant jumps, right? Even the Reserve Bank of India (RBI) has also raised its interest rate 6 times during the same period. Other countries like Brazil, Australia, Canada, France, Germany, New Zealand, and many others have also raised their interest rates to address rising inflation. But why have countries around the world suddenly started increasing their interest rates? Well, I will cover this topic in detail in another video dedicated to inflation. One small request: if you have found this information useful so far, please like this video and subscribe to our community. Your support means a lot. Now, coming back to the first question, how do the increase in rates affect you and me? Let's discuss this point by point. Number 1, loans become more expensive. Suppose you are planning to buy a car or a house and you need a loan. When interest rate goes up, you may have to pay higher interest each month, and so your monthly payments or EMIs become more costly, making it harder for you to afford those big ticket items. Moreover, many individuals and businesses already have existing loans or debts. When interest rates rise rapidly, the burden of repaying those debts can significantly increase. This situation may lead to financial stress and potential defaults, as people might struggle to make loan repayments. Number 2, impact on businesses and jobs. Businesses often need loans to grow or start new projects. When the interest rate goes up, borrowing money for businesses can become more expensive. It means it gets harder for businesses to expand their operations, hire more people, or invest in new equipments. And guess what? It can impact job opportunities for you and me. Number 3, credit card debt becomes costlier. Whenever you swipe or use a credit card, you are actually borrowing money. If interest rates rise, the interest you have to pay on your credit card balance can increase. So simply put, if someone has credit card debt and they don't pay off the full balance on the due date of payment, then they have to pay more interest on the remaining balance, making it harder to fully pay off their debt. Number 4, attractive rates on savings account. It's not all negative and gloomy. Rising interest rates can also have a silver lining. Saving money suddenly becomes more attractive. Banks mostly offer higher interest rates on savings account when interest rate goes up. That means if you put your money in a savings account, you can actually earn more interest on your hard-earned cash. And finally, number 5, impact on the overall economy. When interest rates rise, it affects the overall economy. If people have to spend more money on loan repayments or credit card interest, they may have less money to spend on other things. This can lead to reduced spending on goods and services, which can slow down overall economic growth. It's like a domino effect. However, do remember that central banks carefully consider the risk and economic conditions before deciding on interest rates. They aim to strike a balance between fighting off inflation and ensuring a healthy economy for all. So having a moderate level of inflation is considered acceptable, as it keeps the economy moving at a reasonable pace. However, when inflation stays high for too long, it becomes a problem and adversely impacts the economy. Now moving to the final segment of this topic. Okay, there can be two scenarios here for raising the interest rates. Number 1, raising the rates too quickly, and number 2, raising the rates gradually. If a central bank raises interest rates too quickly, businesses may cut back on investments, hiring and expansion plans, as it becomes too expensive to borrow. Consumers may also cut back their spending on big ticket items like homes and cars, as it becomes more expensive to finance those purchases. On the other hand, if interest rates are raised gradually, businesses and consumers get time to adjust and adapt to the higher borrowing costs. This can help prevent sudden shock to the economy that could otherwise lead to a recession. So there you have it. Rising interest rates can affect all of us, from our dreams of owning a car or a house to the overall economy. Therefore, we should have some basic understanding of interest rates in order to make informed financial decisions. That's all for now, and please feel free to leave any questions or comments below. Thanks a lot for your time, and let's take care of this beautiful world. I'll see you next. And smile, always smile. If you want more such insights, please stay tuned for my next video on how rising interest rates can impact VCs, private equity players and startup funding.